So the consensus on Wall Street, at least here in the U.S., is that there will not be a rate hike at the next meeting when the Fed meets in just about 16 days. Do you agree with this assessment right now, and how do you think that's impacting the markets?
Yeah, I think there's a high chance the Fed will not move because from the recent speeches, they are pretty concerned about the rise in the yields right now. And also, inflation is actually moving in the right direction. So I think it is worth being patient. But of course, we cannot rule out the potential of another rate hike because that is what they put into the dot plot. And so far, they have done what they guided the market. So I think, yeah, we'll just have to wait and see. But anyway, we think we are close to the end of the rate hiking cycle in the U.S. and other major central banks.
All right, so you think we're close to the end of the rate hiking cycle, but you're also looking at inflation here in the U.S., specifically the two reports last week, CPI and PPI coming in a bit hotter, and that's pointing you to invest in TIPS, 10-year Treasury TIPS, Treasury inflation protected securities. Why right now in your mind, and why is that more attractive than equities in this environment?
Yeah, so because of the recent sharp move in the yields, we actually took advantage and added to UK government bonds as well as global inflation-linked bonds like TIPS. So the thing is, the TIP yields have actually risen to the highest level since the global financial crisis. So we find that is pretty attractive. And the US TIPS yield is the absolute level is high, and on a relative basis, for example, versus the UK, is more attractive as well. And also, inflation expectation could be picking up. We also saw from the University of Michigan Consumer Confidence Survey that inflation expectations from consumers have picked up in both the near term and the longer term measure as well. So I think with the higher oil prices and more volatility in that energy market, we think that there could be potential for higher inflation expectations. So we find that the inflation-linked bonds are more attractive in that environment.
So just to be clear, you think that oil prices continue to move higher. Is that on geopolitical tensions, or is there some other reason you see oil prices moving higher?
So I think it's the constraint in supply that generally would push up oil prices. But of course, that layer of geopolitical tension adds further upside risk. And as we saw over the weekend, oil prices have moved much higher. Although we don't think that we're back to that 1970 environment, but the risk is building of higher oil prices because there could be potential escalation, although many officials are trying to diplomatically de-escalate the situations. But overall, the risk is higher rather than lower.